Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, December 29th, 2022. So we've got a couple trading days left in the year here, and actually one, it'll be tomorrow. And what I'm going to do is go over the indexes first, a couple of the market leading stocks. I want to highlight some developments there. Crude, time permitting, then I'll go into crude, natural gas, treasuries, gold, silver, and the U.S. dollar. What I call the usual suspects. Those are the things I cover and trade most often. So let's start out with the indexes, and again, time permitting, I'll get to all those other things. If not, I'll do that in a separate video or with some screenshot charts I'll get out to you. This is the S&P 500. Really not a lot change. I mentioned, and I said I'd probably do it last week. I took some time off this week, went over to Miami, visited family, and I was completely offline really since Christmas. Not on the computers, not watching anything, just kind of set it and forget it. But time to get back into things here. So first off, this is the S&P 500 SPY 60-minute chart. And you can see really, I'm trying to recall my last update before the holidays. It would have been around here. We had this divergent low, I believe I highlighted because I haven't updated this chart. 60-minute positive divergence on the S&P 500. And it's been playing out not for much so far. We kind of went up a little, down a little, and again, I've warned of that all along. The period between Thanksgiving and New Year's is typically a choppy, tough to trade market. As I said, I'll continue to throw out trade ideas, but at this point in time, let me just reiterate: I remain longer-term bearish. Still maintain my downside targets, and those are really in the coming weeks to months. In the shorter-term time frame, as I got out to you earlier today, we had some nice divergent lows across the board on the 60-minute charts, including QQQ. I'll get to that in a second. And so, short-term, I favor a bounce. But I'm going to go over the long-term charts, and like I said, I can't. Let me just say it this way: normally the 60-minute charts I would be maybe more aggressively position long. I took some longs today, just seeing that getting back to where we're at. I missed the breakout earlier today. I didn't get on the charts until I got home, and I'm going to go over that in 1 second. But again, you have the near-term outlook, and that's just days. We have one more trading day tomorrow for the week. Then, if I'm not mistaken, just like Christmas fell on a Sunday this year, therefore the holidays, the market was closed on Monday is when they celebrated Christmas Day. So really, this has been an abbreviated trading week. If I'm not mistaken, I should double check it, but I believe New Year's falls on a Sunday, and they're going to celebrate New Year's Day. The market should be closed on next Monday. So again, if I'm not mistaken, so we're looking at another abbreviated trading week. All right, so that's 60-minute charts clearly look bullish, but what gives me a little bit of pause is when you zoom out to the longer term charts. Remember, this is the big picture, and the big picture will help formulate even on my outlook on the near-term time frames. And so what I mean by that is the 60-minute divergences and bullish setups, and we've already seen that. I've pointed out a couple in the last few weeks, and they played out for a little bounce. NQ, that the last QQQ trade hit the first target, the minimum target, but then went down, made a new low. And so the point being is, when you have clearly bearish action and a bearish trend on the longer term charts, bullish setups on the shorter term charts either don't play out at all, or they tend to play out for a smaller than usual move, a smaller rally than you might get in a bull trend. I'm sorry. And so the big picture is this. This is just a recap, whether it's those of you new, those just catching up. We had this beautiful primary bear market downtrend line right here, and we recently had 2 additional rejections. So that makes it 1, 2, 3, 4, 5. These are weekly candles. And so that last rejection sent us down. We broke this uptrend line. So, from the long-term perspective, the bear market that I believe has more downside to come. We had nothing but check marks recently. These are all check marks. A rejection here, two rejections off the downtrend line. Then you went on to break an impulsive breakdown below the uptrend line off the lows. That's another check mark for the bearish case. You got rejected off the 200-day moving averages, which are the red and blue lines here. Also on a weekly chart, they're the 40-week moving averages, and rejected there as well. So, that's textbook downtrend or bear market action. You had a bear market rally just like this one, also stopped exactly at the downtrend line and right at the 200-day moving average there, just as this first bear market rally was capped at the 200-day moving averages and the trend line. So there it is. Okay, that is, I kind of harped on it quite a bit recently. It doesn't get any better than that. So we had, objective short entries on SPY and QQQ in this bounce target zone, what I call the red box, my most likely bounce target zone, which we hit the top of that in pre-market that day. So it was nice, we could have scaled in anywhere in here. And so far on those swing or trend positions are clearly profitable. So again, my guess is that those 60-minute divergences are probably going to play out, and I'll show you why. It's not just the divergences. We have some key stocks at support. However, if they don't, that's a very bearish scenario, and we could get some pretty quick selling. But I do favor a little bounce here, up to about that 390 level. Same area I was talking last week before the holidays, about 390 on SPY would be, my preferred, near-term swing target, then another leg down. And let's get into the Qs. That's more of what I trade. You get more bang for your buck on the Qs. So again, when I look, this is a daily chart. We had a same thing. We had rejection off the downtrend line, and again, it doesn't show on this chart. It doesn't show the pre-market trade that day. We were right there at the downtrend line and the 200-day exponential moving average in the pre-market session. I highlighted that as another objective short entry for long-term traders or anyone scaling in, and it was right in the middle of my most likely bounce target zone. So far so good there on that. Those short positions from that entry, even after the bounce today, they're still up about 12% profitable from that last entry. And if you recall, when we were up here, I said that if once we got down here and once we broke, this was a big support level to meet 280. That broke down. We've been selling off pretty hard since then. Just a couple. This is again a daily chart, so just a few green days, but nothing big, including today. But so look, my convictions aren't super high on this bounce, but it is what I favor, and that I'll get to the 60-minute charts in a second. That bounce. Calling for same as I was last week up to here about 280. That was big support based on the 60-minute divergences. That's where if we get there, any longs that I have for a bounce trade will be closed out, and I'll reverse into shorts and maybe even add some in the long-term accounts, IRAs and all that I'm swing and trend trading down. So that is my preferred scenario, is a bounce up there and then another leg down. But with that being said, remember, this was a very objective short entry, and it trapped a lot of longs, longs that have been buying into this rally, buying into the fact that the bear market was over. And this is typical, this move down, that impulsive drop is typical bear market action. It traps a lot of longs and denies a lot of short sellers optimal entry. So, and therefore, that could very well continue. Let me show you something here. On the weekly chart, we look at it here. Remember, you have again a clear rejection off the downtrend line on QQQ and the 200-day moving averages, the blue and red line, 40-week, perfect. They both came in together. It really doesn't get any better than that. That was, on a 1 to 10, that was a 10 for an objective short entry to exit any longs who took off the divergent low on the bounce trade. Now, so one thing I'm watching, look at this. You have a PPO, a pending bearish PPO crossover, and I've covered that in the past. This is a weekly chart. Sometimes we'll watch them on the 60-minute or the daily time frames, but you can see it when I put up the histogram. This is when you go from green to red. That's where you have a bearish PPO crossover, and you have one right there, and you're looking at one here potentially if we get any more downside. And they usually signal pretty good trend changes. We had one there, and when that PPO on the weekly is below the zero line, the trend is bearish. So it told you at this point, bearish trend. There was a bull market, a bear market rally. It said bullish right here, and another rally. It hasn't been super strong, but we've been moving up. So that's that. All right, so this is something to watch, and we get that crossover. But so it's consider this to an extent a trade where like I used the analogy a week or so ago, picking up nickels in front of a steamroller is what I'd consider. And if you're an active, nimble trader, then nothing wrong with it. So this was the breakout. Again, I wasn't around this morning to highlight that, but I did highlight it right here, and I said, and I still maintain, ideally. I expect a break above this level about six. I have the line at exactly 267.38. I think I referred to it as 267.50. Looks like maybe a little flagging action right here, bull flagging action. So there's the breakout. It was a nice clean right here. This gives you a bullish falling wedge. The pretty well defined. You have a lot of reactions. 1, 2, 3 right there, 4, 5, several there actually, and then the breakout. And the breakout was impulsive. So on a scale of 1 to 10, that's a perfect 10 right there for what you want to see, including positive divergences below the falling wedge pattern. So there's that consolidation. Earlier today, I got this out to you. I said, next objective long entry on a breakup of 267.50, ideally after a period of consolidation, which is what we've had, or a pullback. And I still maintain that tomorrow. If you pull back, you can buy down to, but I really wouldn't add below 263.24. Anything's possible. You can go all the way down for a back test of the wedge, but this would be to me the ultimate buy zone. Anywhere if you get that tomorrow, my guess, this is pretty strong stuff. And what I'm about to show you here on some of the big market leaders, I think we're just going to gap up tomorrow, pop that, run up to the next level. You can see all the targets. I gave it to you today. I haven't changed these lines since 272. 67, give or take, 275, 62, and then 280, 16. Always sell below the actual resistance level you're targeting, especially on counter trend trades, because the sellers tend to step in early, and that's a big level. So again, if we get up there, and just to measure it out for you, if we hit it, that's going to be about a 5% bounce from where we're at right now. So worth it, if we can get that. But again, don't get married to it, and that's what stops are for. So if you took a position today, or if you take one on a breakout, you can set stops wherever you want them, but I think somewhere a little bit below that 263 level right there is a pretty tight and pretty good stop right there. Okay, futures, NQ. Same chart I got out to this morning. Well, that's a 5-minute chart right here. So I was just looking there, trying to zoom down earlier today, looking at what might happen next. So we had a little divergence, but you can see it here, just like QQQ. This is also the 60-minute time frame. There's your wedge right there. I've been building divergence here on the PPO from all the way back here and from right here most recently. So that's how the wedge would look. I would draw it just like that. There was the breakout. It was impulsive, ran up right to that first resistance level, 11.044, which I think I referred to as we need to break, about 11.045, or really today's highs is what I said. Once we take out today's highs, you might have a little flagging action going on here. That should push us up. I haven't touched these. These were the same targets and resistance levels from last week, and now they act as targets on the way up. So I should really have resequenced these. R1 should really be T1 from this point, first target. Had I, been around and gotten the wedge out to before, that would have been the buy point, and this would have been the first target. But either way, from now, let's just say we take out today's highs. That should open the door for a rally up there. I'm going to give you a little micro level for you active traders that like to trade futures and might want to take a quick buck. I think we're going to have a reaction right there, so I'm going to change that. My first target is 11.173, then 11.263, we'll call it. Same T1 that was hit back here, 11.409, 11.493, and then at most 11.631. I'd also watch QQQ because that chart trades shows the regular session trades. These are the Globex futures around the clock. The QQQ level, wherever that is, the 280 level on QQQ, that is the level that I would sell NQ just shy of. So if it happens during the regular session, I don't know if it lines perfectly with 11.631. It's roughly that level right there. And again, so that should be, let me just measure it out and make sure. Yep, there it is. Right about, yeah, I could add a little more to that line. It's just about a 5% rally from where we're at now. There you go. That's 5% right there 5.1. Yeah, so that's what we're looking at. Okay, so that's it, guys. At most, I think a 5% rally. If you get it, great. Get out of your longs there, reverse for at least a pullback trade, and then another leg down. I always say the charts are dynamic, and so is my analysis. So we'll see at the time, if anything changes. That even going back to where we were a few weeks back, or just a couple weeks ago, I said, if we took out this level, I thought we might see some waterfall selling, and this is a great example of how I say the charts are dynamic, and therefore so is my analysis. Well, the reason I'm not, in the active trading account, the reason I took some longs, I'm not hard pressed in the shorts right now for that, is because of what I just showed you, the divergences and support and everything else. Let me just quickly go over to some of the market leaders. I'm not going to go through them all, but here's Apple. I know this is a busy chart, but it's a daily chart of Apple, and I did highlight this one last week before the holidays. You have still divergent low. That's positive, aka bullish divergence at this point in time. It's still what I call unconfirmed. You need to get a crossover, a bullish crossover here in the PPO with the lines crossing, and that to effectively put in a higher low. As I always say, these are momentum indicators, and it's still heading lower. So if Apple just keeps going down, it's going to take out or negate these positive divergences. However, and I always say divergence in itself is not a buy signal, but you have Apple at support. That was a previous reaction low. We had one right there. Remember the holidays? I told you are plagued with whipsaws and false breakdowns. That's what happened, I guess it was yesterday. You can see that big red candle down through that level, down through the previous low was actually, I'm going to move that line up right there. And so you undercut it. And this, is, my friends, is what we call a bear trap. It's not fully finalized yet, but a bear trap is when you break support. It sucks in bears or short sellers. It also scares out the longs, runs a lot of stops that were placed below that reaction low, and then you reverse back above. So we recover the level, but not by a clear margin. So that's why I think, again, tomorrow, if we can pop today's high, see where the high of this candle was, then you've clearly recovered that, and at that point, you give it a check mark for again, a bear trap. Bear traps are pretty powerful because the shorts pile in, and it shakes out the weak-handed longs. So then you have a better, pool of holders of the stock at that point once the weak hands are shaken out. With the logic being, if you didn't stop out yesterday of Apple, why would you sell the stock today if you bought it recently? It's you're above where you were, and if you keep going up, of course those people aren't going to sell. But who will make a move are the short sellers who shorted that move yesterday, and they get squeezed out. Now on the flip side, if we take out yesterday's lows in Apple, that's not going to be good. You'll probably you have the potential to take out the positive divergences, and then this whole bear trap thing never materialized. So watch Apple tomorrow. It is one of my favorites. I told you last week I took a little Amazon. I took a little more Amazon today, and I even took a starter position in Apple in those long-term accounts to hedge, to at least partially hedge right now against my index shorts on the Qs. So there's Apple. Remember, this is the top weighted component in the NASDAQ 100 and S&P 500. So if these divergences play out, and keep in mind, these are positive divergences on the all-important daily chart. These, if they do play out, have the potential to play out for a multi-week double-digit rally, more than just that 5% I'm looking at. That was the last time we had positive divergence on the daily right here, and Apple rallied almost straight up about 35% or so from there. Okay, so just keep that in mind. And that would certainly, at least put a damper, or temporarily delay that, next leg down in the bear market if this plays out. So let's watch it. And again, if it doesn't, that's what bear markets are all about. You get these bullish setups, and in bull markets, you want to buy with both fists when you see positive divergence on the daily. In a bear market, quite often those divergences don't play out. So I'm not married to it, but I will very much respect those divergences, just like I did back here. All right. And then if we do, look, here's a perfect, nice rally point. If you wonder, okay, Randy, I don't just swing trade Apple right now. I like it. I'm going to take some to, you're talking to move that line. You're talking up to the trend line, depending if and when we get there. That's about 11% if it was a pretty quick move up there. And wouldn't surprise me at all. So if we get there, it's going to look like this. It's going to hit that line, almost certainly get some sellers. I would take profits there. and you could set up a wedge here that could have, longer term bullish implications. Or you run up there and then that's it, and we go down. So I'll address it at the time. Let's keep this simple. Just watch this level right here. Bears win below yesterday's lows. Bulls win above yesterday's high. And I'm talking short term, kind of tactical stuff. All right, and that may be an oversimplification, but that's how I'm looking at it. Let me just jump forward to Amazon. Amazon, I told you a week or so ago, one of my favorites of the big fangs, and again, the one that I'm holding, some long, building a long position in right now. This is just great support on the weekly chart right there. It was a long-term target I had from way back here on the highs, and it's been hit. It's about $83 or so, and you have positive divergence on the weekly chart as well. It's still unconfirmed. That PPO has not turned up. Remember, it is a momentum indicator. It's saying we're going down, or Amazon's been going down. But if it curls up and makes a bullish crossover, that's powerful stuff. The last time we had a bullish crossover on the weekly was right here, where I'm starting this arrow, and we went long there. That was also a target I had on Amazon on the way down. I highlighted several times there as a buy. What I'm also referred to as my favorite of the fangs then, and we had a nice rally off there. So like I said, kind of a mixed bag of technicals. We are in a bear market, so you got to look at these bullish developments with a little bit of grain of salt, but you need to respect them, and you may be able to capitalize on them if they play out. On the daily chart of Amazon, this is how I look at it. I see a downtrend line with just one little whipsaw through there. I'm going to zoom in a little tighter. This is, if you're waiting, maybe you want a little bit more evidence to buy Amazon. There's a downtrend line right there. It's pretty clean off this reaction high in late October. Again, one little whipsaw through it. Other than that, if you have enough reactions to validate it, 1, 2, 3 right there when we went back down through it, and several recently. So we can pop that. Yeah, maybe all the way up here at about 101.45. That would be, let's see if that meshes with the 11% or so in Apple. No, that'd be 20%. So I'll have to study the chart a little more. I could put some more levels in here, which I will, but either way, it's again, these divergences have the potential to easily give you a 20% rally. Remember, this is Amazon. This Amazon is knocked down. PE still high. I'll say that. We're in a bear market. Bear markets bring PEs back down to earth, and usually the pendulum swings, a little bit far in the opposite direction. So by the time before the bear market's over, you're going to probably see Amazon cheaper than it is today. But with that being said, again, great support, long-term support, positive divergences on the weekly, daily that we're looking at here, and even the 60-minute chart. That's what it looks like there. So it's hard for me to get uber bullish, and in fact, this was all the ingredients you need for an early, rally right out of the gates when the new year kicks off. So that's it. So I think the risk reward is worth it, in my opinion. The active trading account to be long right now for those reasons. And then one more I like. I mean, there's several, but Tesla. Okay, Tesla looks like death. I talked about this chart. This is a weekly chart. You have support here at about, what is that, 183.50. It was good support in my opinion. I'm harping on that support for a long time. We also had a trend line right here that was broken. There was an uptrend line, so that broke. Then that support broke. I know Musk has been selling his shares to pay for, finance Twitter. But, it's in free fall, no divergences anymore on the weekly chart, even on the daily chart. No positive. We don't have any positive divergences. But guess what we do have? A potential selling climax. So a selling climax, what you want to look for on a stock that's been in free fall and a persistent downtrend, not just a little pullback. You want to see a downtrend, and of course Tesla from the highs back here. I'm just going to measure it out for you. Tesla has fallen 74%. Okay, so, and you can see the selling has accelerated here. And then what you do is let me turn on the volume bars so you can see them nice and clear. All right, so see this surge in volume recently? That is, or has the potential to be, in hindsight we'll know for certain, what we call a selling climax, where the sellers, or the longs, the holders of this stock just puke it up. They can't take the pain anymore. They capitulate. They're underwater big time, especially those poor, a lot of people bought Tesla. If you look at the volume at price histogram, or just the price in general, the last couple years, most people bought Tesla up here. So almost everybody's underwater. Only people that aren't underwater are the ones that bought it way back here. Now, so you see that surge, and that tells you it's an indication of a selling climax where the sellers are now exhausted, and you have so far a reversal. It was up about flat yesterday. I can't even see, I wasn't around, but today was a decent day, and again, based on that alone, so no divergences, no wedges, nothing else, but that is a potential bottom right there. And how to trade it? Well, it may not be a bottom. Take it with a stop below the recent lows. It was up quite a bit. That means you have about 8% or more downside to take out those lows. But if it was a selling climax, they're more lasting bottoms, by the way, guys. They're not just bounce trades. That would send Tesla, in my opinion, all the way back here to maybe back test that 179.50-ish support shelf. So that would be, even though the stock was up 8% today, that would still be another 46% in Tesla. And that would have a pretty good weighting on the, impact on the indexes. So, all right, these are the things I see. And there's also, what, I just looked at it as I put the crosshairs there. There was some support right here. You can see that reaction low, reaction high right there, reaction low. And so, anywho, and so that would also build a case for putting a stop a little bit below that 109.73-ish level. The only other one I'll highlight, because I'm watching the semis, is NVDA, and I'm gonna wrap this video here and just keep it limited to the indexes and these market-leading stocks because they're directly related. I'll cover everything else. I'll give you updates to maybe tomorrow on gold and treasury bonds. There's not much. I'll just tell you right now on gold and silver, not much of a change in my outlook. The dollar has had that correction we were looking for that gave us that big boost in gold. I remain longer term bullish gold and silver, but near term, I think they're just the currencies, the dollar and the euro may continue to put some pressure on them. In other words, they may consolidate or even pull back and correct here soon. Any corrections would be a buying op, and I'll highlight those later. I'll also go over treasuries in another video. We're either poised to break out and rally, but let me get to that in another video. All right, let me just finish up here with NVIDIA. NVIDIA has also had a nice correction. This is really now the king of the chip stocks, and that's really nice support, 143.87. It's a line I've had here a long time. You can see it was resistance, resistance, resistance. One little failed breakout attempt, resistance, broke out, back tested it there, and off to the races. Came all the way back in after the bear market started, had a nice rally off that level, checked it twice, held it, and then we gapped down below it, and that was a break of support. Support once broken becomes resistance. Then we rallied, we tested the resistance for several days, and then boom, breakout. And so now we're back to it. So this is TA, or Technical Analysis 101. You had a downtrend line. This coincided with that last short we had, or the optimal short entry on the indexes, QQQ and SPY. When we rallied, they also just, NVIDIA, just like those, not by coincidence, hit its primary bear market downtrend line. So again, on 1 to 10, that was a 10 entry for shorting. However, we're down pretty good. It's been a drop in just a matter of what, a couple weeks, 25, 26% to support. So I have to say, I'm looking for a bounce here because we have a lot of again, not just divergences, but key stocks at support, and even better than falling to support. The only thing better, in my opinion, buying a stock that's oversold down to support is one that undercuts that support, then immediately regains it again, giving you that bear trap. That gives you that extra fuel for the rally from those shorts that might have jumped in and shorted it on the break of that support. And now, or more importantly, if and as we go up, they're going to be squeezed out. And remember, when a short seller covers their position, they're buying a stock, so that adds to the buying pressure. And that's that. So anyway, a maximum bounce target, again, maximum, I don't know, I'll have to sharpen my pencil on this one, would be the downtrend line right there, right now. Okay, let me wrap it up here. Like I said, I'll update those other things. Nothing crazy out there now. I'm looking for a bounce soon, either from where we're at now in treasuries, or maybe one little additional leg lower, minor leg more drop lower. Natural gas looks to be setting up again. It didn't bounce at the last time I highlighted its support, but it's also got some nice divergences. So treasuries, natural gas, and those two, let's just stop there. Those look poised to rally soon. in the stock market, like I said, it's if it can build on, take out today's highs, then that's going to likely open the door for a next leg up and help firm up the case for that rally again, at least a 5% or so rally in the NASDAQ 100, possibly more. Again, if these market leading stocks, if those daily divergences play out and give us that 11% on Apple, or 40, whatever it was on Tesla, things like that. So we'll pick it up tomorrow, and of course tomorrow's going to be Friday, so we'll try to figure out, I'll share my thoughts as how I'm going to head into the weekend. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.